Does this stock have a high price tag? In value investing, it's among the most often asked questions. Stock prices fluctuate for a variety of reasons, as you may already be aware, so if you're interested in a certain stock, it's important to know when to buy or sell. Today, I'm dissecting the price-to-earnings ratio, or PE ratio, a crucial metric that helps assess whether a stock is cheap or overpriced. Following this video, you will comprehend the basic types of PE ratios, their advantages and disadvantages, what the PE ratio says investors about a company's valuation, and how to interpret it in various situations. Hi there, this is Smart Money, a site that provides straightforward explanations of investing concepts. First, though, a brief disclaimer. Let's begin with the fundamentals. The price is at the top of the price-to-earnings ratio, while earnings per share are at the bottom. Simply explained, earnings per share, EPS, indicates the amount of profit a firm makes for each share of its stock. If you're not familiar with the term, watch the video that is linked in the top right corner. It is calculated by taking the company's total profit after taxes and expenses and dividing it by the number of shares investors own. This tells you how much of the company's earnings belong to you if you own one share. Now back to the PE ratio. This formula helps you evaluate how much investors are paying for each dollar of a company's earnings. For example, if a stock trades at $100 per share and its earnings per share are $10, the PE ratio is 10, meaning investors are paying $10 for every dollar the company earns annually. Technically, if earnings remain constant, it would take 10 years to recover your investment. But why does the PE ratio matter? It helps you understand if a stock is potentially overvalued, undervalued, or fairly priced. Consider it a gauge of what the market expects. Generally speaking, a high PE ratio may indicate that investors anticipate rapid future growth from the company, whereas a low PE may indicate that the stock is cheap or that the business is having difficulties. PE ratios range significantly among industries, reflecting variations in risk, company structures, and growth prospects. In developing sectors like technology, biotechnology, or e-commerce, where investors pay more now in anticipation of significant future returns, high PE ratios are typical. For example, because investors expect substantial growth, a tech startup with cutting-edge products may have a PE of 50 or higher. However, because they expand more slowly or are correlated with economic cycles, established or cyclical industries like manufacturing, utilities, and energy frequently have lower PE ratios. Companies that aren't yet profitable, like early-stage startups or highly indebted businesses, may have negative or undefinable PE ratios. Investors in these situations concentrate on other indicators, such as revenue growth or prospective future earnings. There is a standard PE range for each industry. Consumer goods companies, for instance, frequently have moderate PE ratios that indicate consistent demand. So, comparing a company's PE ratio to the industry average is more meaningful than looking at it in isolation. Imagine two companies, Fresh Bite and Tasty Treats, both in the consumer goods sector. Fresh Bite stock is $50 per share with earnings per share of $5, giving it a PE of 10. Tasty Treats stock is $75 with the same 5 EPS, giving it a PE of 15. Both are profitable, but Tasty Treats' higher PE suggests investors expect faster growth. Maybe it has a new product or a better marketing strategy. If the industry average PE is 12, Fresh Bite might be undervalued while Tasty Treats might be overvalued, unless its growth expectations are realistic. There are also two main types of PE ratios, trailing and forward. Whereas the forward PE is based on anticipated future earnings, the trailing PE uses past earnings over the last 12 months. Both are helpful, but they convey different information. Forward PE is based on forecasts, whereas trailing PE is based on actual past data. Let's look at an illustration. Consider the solar panel maker Brightech, whose stock is trading at $100 per share. The trailing PE is 20 because the EPS was $5 last year. According to analysts, earnings will double to $10 next year, resulting in a forward PE of 10, which indicates optimism and potential value if projections prove accurate. However, the stock might not perform as anticipated if those forecasts are incorrect. On the other hand, the forward PE would increase to 25, suggesting an expected reduction in earnings. if Brighttech's ahead EPS were predicted to fall to 4. The PE ratio is a useful tool, but it's not flawless. These are its benefits and drawbacks. It is helpful for comparing businesses in the same industry and is straightforward to compute and interpret. However, it ignores debt and cash flow, fails to take into account long-term growth potential, and may be deceptive if earnings are momentarily high or low. Furthermore, it depends heavily on the industry, so context is crucial. The PE ratio is therefore usually used in conjunction with other metrics by astute investors. In conclusion, a low PE ratio does not necessarily indicate that a company is cheap, and a high PE does not necessarily indicate that a stock is overvalued. The context and the foundations of the business determine everything. Did you find this explanation useful? Please leave a comment below, and remember to like and subscribe for more beginner-friendly investing advice if you want to continue studying the fundamentals of investing. I appreciate you viewing, and I hope to see you in the future one.